You've been told investing is complicated. That you need a financial advisor, a fat bank account, and a finance degree to start. That's wrong. All of it. The single most effective way for a normal person to build wealth over time is boring, simple, and costs almost nothing to start. It's called an index fund. And by the end of this video, you'll understand exactly how it works, why it beats most professional investors, and how to start with as little as $50. No hype. No crypto. No options trading. Just the boring, proven math that has created more quiet millionaires than any other investment in history. Let's break it down. An index fund is a type of investment that owns a tiny piece of every company in a specific market index. Think of an index as a list. The S&P 500 is a list of the 500 largest companies in America. Apple, Microsoft, Amazon, Google, Nvidia, they're all on that list. When you buy one share of an S&P 500 index fund, you're buying a microscopic slice of all 500 companies at once. You don't pick stocks. You don't try to time the market. You just buy the whole haystack instead of looking for the needle. Here's why that matters. If one company crashes, say a scandal takes down a single stock, your portfolio barely moves, because it's 1/500th of your investment. The other 499 companies keep doing their thing. The risk is spread across the entire market. You might think professional fund managers, people paid millions to pick stocks, would beat a dumb list of 500 companies. They don't. Over any 20-year period, more than 90% of professional stock pickers underperform the S&P 500. Not 50%. Not 70%. Over 90%. This isn't my opinion, it's data from SCHB, which tracks professional fund performance globally, year after year. Why? 2 reasons. First, stock picking is genuinely hard. Markets are efficient enough that finding mispriced stocks consistently is almost impossible. Even the pros get it wrong most of the time. Second, and this is the part nobody tells you, professional funds charge fees. 1 to 2% a year doesn't sound like much, but compounded over 20 years, it eats a massive chunk of your returns. An index fund charges about 0.03%. That's not a typo. 0.03%. The math is brutal and simple, the pros can't pick stocks well enough to overcome their own fees. The index fund wins by not trying to be clever. Let's talk about the actual numbers. This is the part where most people's eyes glaze over, but this is the most important part of the video, so stay with me. The S&P 500 has averaged about 10% per year over the last 50 years, adjusted for dividends. After inflation, which averages about 3%, your real return is about 7% per year. That 7% is the magic number. Here's why. If you invest $100 a month, that's about $3.30 a day, starting at age 25, and you get 7% real returns, by age 65 you'd have about $263,000. You put in $48,000 total. The other $215,000 is pure compound growth. Now here's where it gets insane. If you wait until age 35 to start, just 10 years later, and invest the same $100 a month, you'd end up with about $122,000. That 10-year delay cost you $141,000. Not because you invested less, you only invested $12,000 less, but because compound interest had 10 fewer years to work. Time is the single most important factor in investing. Not how much you invest. Not which stocks you pick. Time. Okay, you're convinced. How do you actually buy an index fund? It's simpler than you think. Step 1. Open a brokerage account. In the US, the 3 most popular options are Vanguard, Fidelity, and Charles Schwab. All 3 offer index funds with near zero fees. You can open an account online in about 15 minutes. Step 2. Choose your fund. The most common starting point is an S&P 500 index fund. At Vanguard, it's called VOO. At Fidelity, it's called FXAIX. At Schwab, it's called SWPPX. They all do the same thing, track the 500 largest US companies. Step 3. Set up automatic investing. This is the most important step. Don't invest manually when you feel like it. Set up an automatic transfer from your bank account on the same day every month. $50, $100, whatever you can afford. The key is automation. You invest before you see the money, before you can spend it. Step 4. Do nothing. This sounds like a joke, but it's the hardest part. When the market drops 30%, and it will, that's normal, your instinct will be to sell. Don't. The market has always recovered, historically. Every major crash in the last century was eventually followed by new all-time highs. The people who lose money in index funds are the ones who panic sell during a crash. The people who make money are the ones who do nothing and keep buying. The S&P 500 is great, but it's 100% US companies. What if you want global exposure? You have two options. Option 1. Buy a total world index fund. These track thousands of companies across dozens of countries. The most popular is VT from Vanguard, or VTWAX for the mutual fund version. Schwab doesn't have a single total world equivalent. Instead, you can combine SCHB for US total market and SCHF for international. This gives you global diversification. Option 2. The 3-fund portfolio. This is a strategy popularized by the Bogleheads, the investing community named after Jack Bogle, the founder of Vanguard. You split your money across 3 index funds, a US total market fund, an international fund, and a bond fund. The bond fund adds stability. Bonds don't grow as fast as stocks, but they don't crash as hard either. A common split for someone in their 20s or 30s is 80% stocks, 20% bonds. But here's the truth, if you never buy anything except an S&P 500 index fund for your entire life, you'd still be ahead of 90% of investors. Diversification is a bonus, not a requirement to start. There are 3 things that will try to destroy your returns. Know them in advance. Enemy 1, fees. We covered this. An index fund at 0.03% is almost free. But if you accidentally buy an actively managed fund with a 1.5% fee, over 30 years that fee will cost you more than the actual money you invested. Always check the expense ratio before buying. Enemy 2, panic selling. The market drops 10% about once a year. 20% every 4 to 5 years. 30% or more roughly once a decade. These are normal. If you sell during a crash, you lock in the loss and miss the recovery. The worst days in the market are always followed by the best days, usually within weeks. Enemy 3, lifestyle creep. As your income grows, your spending tends to grow with it. If you get a raise and your expenses go up by the same amount, your investment amount stays flat. Every time your income increases, increase your automatic investment by at least half the raise. Let's summarize the entire strategy in one paragraph. Open a brokerage account. Buy an S&P 500 index fund. Set up automatic monthly investing. Do nothing when the market crashes. Increase your contribution every time you get a raise. Repeat for 30 years. That's it. That's the entire strategy that has created more wealth for ordinary people than any stock tip, crypto coin, or real estate scheme in history. It's not exciting. It's not a secret. It's just math, patience, and discipline. The hardest part isn't the strategy, it's starting. Most people spend years thinking about investing before they actually do it. Every year you wait costs you tens of thousands of dollars in compound growth. The best time to start was 10 years ago. The second best time is today. If this made index funds click for you, subscribe. I break down one money concept every week, no hype, just the math that works. And tell me in the comments, what's holding you back from starting? Is it fear of losing money, not knowing which fund to pick, or something else? I read every comment. Links to the funds mentioned are in the description. That's for reference, not a recommendation. Do your own research or talk to a financial advisor for your specific situation. This video uses AI-generated narration and visuals. All research and financial framing are my own. Not financial advice, educational only. See you in the next one.